You got all this stuff going on, trade wars, potential for a slowdown, tensions in the Middle East, and stocks don't care.
Well, I think that this is actually typical reaction after you get an indication, a very clear indication from several central banks, very important central banks, that they're going to be easing. This you do tend to have a knee-jerk, very significant rally at that point. Now, at some point, I do feel that stock markets are going to remember that there is a global growth slowdown underway. At some point, earnings are going to continue to weaken off, and that may be the point where equity markets see some kind of reversal. I would say, though, however, the G20 discussions next week are going to be very important. If we do see progress there, then this rally can continue for a bit longer.
Is it really all a central bank play? Because if it is, Seema, if indeed that it is, it almost seems like whatever happens with the trade battle between the U.S. and China, whatever happens with Brexit where you are, won't matter.
I think it will eventually matter. Ultimately, earnings is going to be what's driving equity markets. If you have a situation where trade talks are continuing and there is more uncertainty for businesses, where do we invest? Where should we put more investment plans? These things do weigh on global growth eventually. So we would expect that maybe when you get to the Q2 earnings season and then you get Q3 guidance as well, that some of that negativity starts to leak in, and that's when you will see markets really taking notice of all of the external tensions beyond what the central banks are able to do. And the other thing is, of course, with interest rates so low around the world, we're looking at a point where there's diminishing marginal effectiveness over here. Interest rates can only do so much. Central banks don't have that much firepower left. But at the moment, markets are enjoying this, and there's also a search for yield, which is really, really helping things along.
Yeah, is the fact that bond yields, they're 2% here, but they're negative at $12.5 trillion in global debt. Does that just simply push people into stocks? Because, it's bad enough making 2%, which is basically zero real return with inflation, but where you are, you're making a negative real return.
Absolutely. The thing is we have a search for yield, so it's equities, it's credit as well. People are just looking for some of that there. The other thing is that, look, we still don't expect there to be a recession, so you should still be invested. This is not time to be in cash. But maybe the best thing to do is to allocate yourself defensively, be a little bit more cautious. And that means looking at the sectors such as REITs, utilities, insurance, which tend to be less cyclical. And also maybe looking at US equities over other international regions. Because the US is less trade dependent than other regions, it also has more room fiscally and with monetary stimulus as well, which means that they could probably outperform the rest of the world. But there is space to be in risk, but it is about being defensive.
So what does defensive look like to principal global investors? What's a good defensive investment for our viewers and listeners to make right now, Seema?
There's a couple of things. So one thing is to look at REITs. That's one of our favorite areas to be in. It has really outperformed, and I know a lot of people will be saying, well, look, they are really, really expensive already. Well, they are, but they will continue to become more expensive as you see this global growth slowdown play out. The other areas are, of course, insurance. We're looking at stuff like consumer staples. And then within credit, you're looking at the safer places. So that's investment grade over high yield. You're moving up the curve. And you're also just generally looking at higher quality stuff. And finally, we really like mega caps at the moment because large companies are the ones that will be able to deal with the very difficult environment that's likely to be hitting the global economy.